Hello and welcome to Fintech Focus TV with me, Toby. Today I am utterly delighted to be joined by John Greenan from Alignment Systems. John, how are you?
I'm very well, Toby. Thank you very much. How are you doing?
I'm really good, thank you. Really good. Listen, it's lovely to see you. Been a while, and I always love talking to you because there's so many different things that I know you've got a great opinion on. And this is a time of fascinating developments within the capital markets and financial technology. And we've been talking through loads of different areas that have been doing with so many people over the course of the last last 100 odd days, 115 days, I think it is now, wherever it is. Your background spans many different sort of markets. You've been consulting all over the world, and seen some really interesting things. Give us a little bit of background about you, if you will, first and foremost, and then we'll dive into some of the things that we want to talk through as well.
I started off. I studied economics. I started off in private client wealth management. I left that, went to work for a financial technology vendor before the word fintech existed. Financial technology. I did that for a couple of years. I changed gears. I moved to Japan. I went to work for an investment bank in Tokyo. The investment bank I went to work for was acquired, and so that sort of changed quite radically. Moved back to the UK. I went to work for a large sell-side technology vendor in the equities trading landscape. So if I said they're based in Woking, you know who they are. Had 2 happy years there. And I reached a point where I thought that I'd be better off actually running my own business. So way back in the depths of 2002, I set up Alignment Systems. My underlying point for the name was around, you've got to actually align your technology and your people and your processes to get the optimal outcomes. And that's what we've always tried to achieve. So I set up the business then. Since then, we've worked with investment banks, asset managers, hedge funds, stock exchanges, trading venues, interdealer brokers, cryptocurrency firms, a few other firms in the broader market, and technology suppliers to those firms. A lot of what we've done is helping companies to get projects over the line or to scope out projects. I've had the pleasure of working in Canada, America, Britain, Ireland, France, Belgium, the Netherlands, Japan, Singapore, Hong Kong, Sydney, Melbourne, Zurich, pretty much everywhere.
Is that all?
I could keep going, but I won't. It'll get a bit dull. But really, it's all within the range and the realms of electronic trading. So the full life cycle from buy-side portfolio management, decision-making, decision support, buy-side trading desk, through to investment bank, broker, interdealer broker, exchange. Quite a lot of the work that we've done has been around FIX. I've been involved with FIX for a long time. Some small parts of the FIX protocol have got my fingerprints on. The next version of FIX is called FIX Orchestra. And if you're watching this on YouTube and you go up to the search box and search for FIX Orchestra and my name, you'll see a video I did at the London Stock Exchange in 2017 about FIX Orchestra. And if you want to get involved with the working group, get in touch. We'd be delighted to have people join. But that's really what we do. We help people out. We try and do our work. A lot of what we do is not covert. We're not special forces. We're not the SAS. But we don't go around.
The SAS are fintech, surely. There's your strap line.
I don't carry a big gun, and when I walk in the room, I don't kill all the bad guys. I generally shake people's hands and offer to buy them a cup of coffee.
Well, each their own. And I think that when you look at all the sort of areas and the diversity and the breadth of what you're talking about, one of the things that's been really interesting for me is particularly during this period, has been the sort of rapid evolution of everything that people have been knocking on the door in financial markets for a long time. We've seen huge efficiencies that people have maybe just sort of dipped their toes in the water for a while because of fear or because of cost or because of conservatism more often than not, and huge procurement processes. Those procurement processes are now starting to be a little easier, I think, through this period, and the legacy of whether that continues is a different story. But one of the core things that's been a sort of theme for me over the last 15 years, I'd say plus, has been the sort of the gradual adoption of cloud into financial services. And I think it's evolved at various stages. I'd have thought it would have come through 10 years earlier to the level it is at the moment. I think it's been probably 5 years behind the commercial world in some of the financial services thus far, in my opinion. That's accelerated relatively quickly. I know you've got some ideas around the whole onslaught of cloud technology and how some is potentially a little bit more valuable than others. Give us your thoughts on that.
Well, I think that you've got to start off with why has cloud technology really become a thing? And it's because of this, the iPhone. If you think back to the dull old days where you'd have a Nokia chocolate bar phone, it didn't do very much. And now your iPhone has basically got the same compute and storage as a 1970s supercomputer. But when you buy a new iPhone, you stick your SIM card in it, you type in your email address and your password, and Shazam, all your emails are there. And now you can send emails, now you can do things, and it all just works. And it all just works is now the cultural ethos and expectation of a whole generation of people who've grown up in the iPhone era. So what I see is that people have been pushing the cloud as a way of delivering technology to companies, but it's taken for there to be the supply and the demand. And the demand is now that people are reaching positions of power within organizations, having their hands on the levers of power to say, yep, I don't care about doing an upgrade of this rubbish old OMS that I've got. I don't want to hear about how I've got to run it with this version of Oracle and this version of Java, and that version of Java isn't supported by Oracle anymore because it's so old. And I don't care about any of that. I want it to be like my iPhone. I want it to just work. I think that the real challenge is that if you look at companies like Apple, their market cap is going on for $1 trillion. They're huge. They're very profitable. Their sales are huge, but they target the retail market. So each individual customer is completely unimportant to Apple. If you decide not to buy a new iPhone, they won't care. In the fintech world, each customer tends to be more important to the vendor. And what we've really seen has been and it's not my term, it's one I'm sure a lot of people have heard, cloud wash. People say, oh yes, our technology runs in cloud. And what they really mean is they have lifted and shifted from being an on-premise offering to running it in a third-party data center like Equinix or whoever else. But it's not really using anything cloud native. It's not using anything like that. It's a lift and shift. It's really a managed service. The problem with that is that it doesn't scale. That's the real premise that cloud offers, to say, we've built this to scale, throw more boxes at the problem and it will work. Whereas if you're looking at running a buy-side OMS or sell-side OMS or a risk management system, and what you're doing is running multiple instances of it, each of which has multiple instances of interfaces to accounting platforms, to data vendors, to index data providers, and a whole different range of data. If you're just running n times that, then each of those n instances requires pretty much the same number of support people as it did when it ran on-premise. So I think that within the broader fintech market, a lot of companies have tried to do the cloud wash thing of say, yeah, we run in the cloud. And what they really mean is we bought some rack space in a third-party data center and we're trying to figure out how to run it. Yeah. One of the challenges from this perspective is a vendor might say, we can run this in the cloud, but what's your service level going to be like? What I've seen with a lot of, in the asset management space particularly, there's been a lot of move to say, well, we want to simplify our technology landscape. But the question is around, what's the lowest price you can offer this to us? Whereas the smarter question is to ask, what's the price that you can actually charge to sustain your business model and offer us a product that's going to keep up to date with what's going on in the market? And that is a more nuanced conversation, and it's also a more grown-up conversation, and it's not one that a lot of companies have got a lot of experience in, Because in the past, it's tended to be a case of, I'm a buyer of tech, I want to pay the lowest I can get because I know I'm going to get messed around and screwed over, and I'm going to end up hating this vendor within a few years and want to throw them out. And the vendors sit there and go, we know you're going to try and take the mickey out of us and, you know, get something for nothing and expect us to do all this work for you for free and try and say it's not a work package, it's a bug fix. And so we're going to mess you around. So I think that really the landscape is changing in that some firms are just being a bit smarter about how they go about procurement, not in terms of the contractual side of procurement, but looking at procurement as being a strategic part of their business. And that's quite a difficult thing to do. A little war story, but one of my clients was quite happy to pay nearly $1 million a year for some technology from a vendor. I was engaged by the client and was working with them. And I said, you know, can I try and help you with that? I made 2 phone calls and the vendor's price that they were proposing dropped to closer to $500,000. I made another couple of phone calls and brought it below $500,000. The thing is that was based upon, they realized I knew what the fair price for the product was. And if you don't know what the fair price for a product is, it's very hard to actually negotiate. And one of the challenges is if you've never bought that particular piece of technology before, how do you know what it's really worth in terms of the value it adds to you?
So with regards to that sort of pricing and how you know, companies steer through that, I mean, is it purely about the luck of or the strategy of working with people like yourselves, or are there, you know, does that point to a sort of, you know, a far bigger issue into how companies and vendors are positioning themselves at the moment and how they're exploiting the marketplace?
One of the things you might recall, and I'm sure a gentleman of your tastes wouldn't be aware of this, but there's a lager called Stella Artois.
I don't know what you're talking about.
As I said, I'm sure a gentleman of your tastes wouldn't be aware. But their advertising line used to be in England, reassuringly expensive.
Yeah.
Now, a good friend of mine is from Belgium, from Leuven, which is the town where Stella Artois is brewed. And I remember the first time I said this to him and he burst out laughing because in Belgium, Stella Artois is viewed with all of the gravitas and credit that Carling Black Label is viewed in Britain. It's a fairly run-of-the-mill type of beer. What's the relevance? Well, a lot of tech vendors used to be they would hire, you know, high pressure, aggressive salesmen to sell their products, very much target driven, and that would cause its own set of problems. They would oversell products and then fail to deliver. That kind of thing is tailed off now. But what I'm seeing is that some of the vendors have actually flipped it round and said, we are reassuringly expensive. The question is, are you getting value for money? If you pay, using a simple analogy, if you pay Ferrari money and you get a Ferrari, you should be relatively happy. If you pay Fiat Punto money and you get a Fiat Punto, equally you should be happy. The problem is if you pay for the wrong one and you get the other one. That's really where a lot of the procurement problem exists, because people don't really know what a fair price is and they don't really understand how to write SLAs. So they end up with having awful instances of service level agreements. As an example, a client of mine, I wasn't involved with any element of this, I just happened to work there in a different capacity. Their most senior trader, a man whose P&L expectation was multi-millions a week, one of his desktop computers, the cooling fan blew up, so his computer overheated and just shut itself down. So he called over the help desk guy and said, my computer's broken, you know, bring the trolley over, get me another one, you know, I want to get back in the market. The company just outsourced all of the desktop support, and the desktop support guy said, oh, we don't have the trolley anymore because that's assets sat there, unused, and we're not allowed to do that anymore. We're only allowed to buy computers when there's an order. So it's a 48-hour turnaround for the computer. So the trader said, thank you to the desktop support guy, picked the phone up to the...
I'm sure exactly in that terms as well.
To be fair, he was very polite to the desktop support guy, because the desktop support guy was just recounting what he'd been told to say. He didn't bother to take the debate any further. He just picked up the phone to the person in charge of the European Investment Bank and said, you want to tell your CTO to extract the digit and get the computer here. The CTO very hurriedly turned up at his desk, asked him what the problem was, and a computer was procured from pulling it out from somebody else's desk. But they hadn't thought of the SLA, which is quite radically different for somebody working in a retail bank where a 48-hour turnaround might work. Whereas if you're a star trader earning big bucks, you want that guy's computer fixed either immediately by having a backup, or within minutes, because the opportunity cost is so high. And that's really what I've seen a lot of. Companies don't, and it's not a criticism, it's that if you don't do it terribly often, you're probably not very good at it. Think of things like in your house, for example, there's a picture frame behind you. You might hammer a nail in the wall to put the picture frame up, but you probably don't fit a boiler yourself, because that's a once in 15 years job. And you've got to have various qualifications to fit a gas boiler, because it's dangerous work.
To be fair, I'm not trusted to do either.
But I think that it's just the lack of frequency of procurement means that people who are doing it are inexperienced, and inexperienced people can get lucky, or as normally happens, they'll make some mistakes as they're learning on the job.
I think this sort of segues quite interestingly into the world where we first started talking, whenever it was 10, 12 years ago now. And, the world of the OMS and everything that we were talking about, back at that. And there's been a tremendous sort of development over the last 10, 12 years within that, with a lot of consolidation. At one stage, there were new players popping up left, right, and centre all the way through. That's probably not been quite such the case at the moment. I know it's been the world where you've got, those buy-side order management systems have been an area you've lived in for a long, long time. Tell us what's happening there at the moment. What's your view of the marketplace on the buy-side OMS space?
I think it's really, there's one winner and n number of losers. The winner has been BlackRock Solutions and Aladdin, which have been picking up new clients. I've been told that Larry Fink has a punchline that he can help you and your firm be the second best asset manager in the world. And they've picked up a huge amount of business. I won't name names, it's all in the public domain and people can find it out if they're interested. But they've picked up a lot of business. They've won a lot of business against their competitors. And it's been a very tough marketplace to be selling into. We've seen a number of firms kind of fall by the wayside and just turn into care and maintenance mode from the supplier. The one that's, I think, going to be interesting to see how they go forwards in the future is Charles River. Having been acquired for a huge amount of money by a custody bank, it's going to be interesting to see how people who don't use that custodian but use Charles River, how that interoperability is going to work, and how are they going to take the product forwards, how are they going to commercialize it. They've been moving to using Rackspace as a third-party data center provider. It's more of a lift and shift than a cloud-native, cloud-first implementation. But with State Street's, pretty substantial financial backing, they really have got the opportunity to offer a very compelling value proposition. The thing is, can they bring it to market? And are they going to find that people who've moved away from the product over the last few years because they've been unhappy with certain elements of the service or the product direction will either stick around or come back. I think that dynamic is a very, very tough one, because there's the old saying of fool me once, shame on you, fool me twice, shame on me. And I think that the RMS space, because it's such a big investment that a firm makes, it tends to be that you only shift from one RMS provider to another when you've gone through the cycle of implementation and support and got so fed up with them, everybody's just fed up and want to change, or got a change in management. And then the new head of technology will be able to say to the business, well, actually, guys, you know, what would you like to have instead of the existing system? Because you're not happy, I'm not wed to it. So what should we do? Market, you know, big old firm as well. IHS Market is this now. They acquired ThinkFolio as a vaguely interesting aside, but I first came across ThinkFolio when it was an in-house product at what was Guinness Flight Asset Management, then became Investec. Andrew Walsh was the head of technology, and I was consulting to his firm through a company looking to replace a whole bunch of legacy platforms for the year 2000. And I've followed ThinkFolio from afar, been a client, worked with them. It's been a very interesting product. There's an opportunity for them to sort of combine with a whole bunch of the IHS Market products and to create more of a ecosystem play rather than a simple product play. So there's some room for maneuver within that market, but the wars that used to exist, the sort of, you can always think of it as being mods versus rockers or Beatles versus Stones, sort of Charles River versus Latent Zero. It's kind of all over, because I think the reality is that the economics of the RMS has never stacked up, hence why they're always looking for the next client to actually provide the bonuses and the pay rises for people to stick in the firm. But most companies have recognized that you need the surrounding technology right as well. So within the equities trading space, certainly in firms I've worked with, start off doing connectivity out of an OMS, and if you've got a reasonable sized business, you then put an EMS in and rip out the RMS connectivity. Been there, done that, worked with all of the EMS providers as well. Historically, in the equities business, it was really simple, because the commission flow that the sell side made from the buy side had to pay for the cost of connectivity and pay for the profitability that the bank wanted. So that made sense for the sell side to subsidize the EMS for the buy side. Fixed income space as a spread-based market, it doesn't work that way. And so we've kind of got some companies trying to build and trying to not so much build the technology, but build a business around fixed income EMS. But the RMS battles are over. It was the Beatles versus the Stones, mods versus rockers, Charles River versus Latent Zero. It's all over. Aladdin has won that war.
Yeah, coming from right behind the pack as well, isn't it? It's a fascinating story on it. This version of the truth that I have heard is there were 6 people in a room who originally built Aladdin. I've had the pleasure of working with 3 of them, and you know, it's clearly grown into a huge business now. It's going to be interesting to see where BlackRock take that product. There's whether they want to move more into providing post-trade capabilities. Do they want to look at creating a more powerful eyeball? Do they want to provide more of a data-centric model? Where do they take that product? And I've certainly seen that companies that have put Aladdin in haven't
reached the holy grail that they were looking for, that it solves certain problems very well, and it doesn't solve other problems very well. And it's not without its downsides. The real challenge, I think, is that because of the cyclical nature of the business, you only put in a new OMS infrequently, and now people have said, right, Aladdin's the solution. And if you've just spent X hundreds of million, well, you're not going to rip and replace anytime soon. So it's an interesting time in the market. There's room for new entrants to come into the market.
That's what I was going to ask as well, because we haven't seen that for a while. So
there's a few small players kind of bubbling under. I think the problem is that people have a level of sophistication they demand now, which they didn't have when they first selected an OMS. Yeah. So if you were to dig out some of the old Charles River or Latent Zero documentation from nigh on 20 years ago, you'd look at it and think, well, you can't do this, you can't do this, you can't do this other thing. But now people have that level of expectation. I put it almost, if you think of it, 20 years ago, if you bought a car, you didn't expect to be able to talk to your car and tell it to tune into Radio 4. Whereas now, voice-activated infotainment systems are pretty standard. The entry price to the automotive world has gone up, and in the OMS space, it's shot up as well. So it is a difficult one for any firm that's looking to go into that world to actually come in as a new entrant, because you've got to either spend a huge amount of money up front to build the platform and then try and monetize it, or you've got to do it the old way of, build a small subset of functionality that suits client A, use that funding from client A to build the functionality for clients B, C, and D, and bootstrap it. And people don't really want to bootstrap anymore, because I come back to the earlier example of the iPhone. It just works. If somebody said to you, here's a old school BlackBerry with a BlackBerry Enterprise server, and you've got to set up PIN codes and all of this old stuff from, no, I'll just stick with the iPhone, thanks. So the cost of entry to the market's incredibly high now. And so it's really only going to be a comeback play, or a unexpected incumbent decides to do something different. If one of the big asset managers was to silo off its own in-house tech and offer that to the market, but having built it correctly in the first place, that's an interesting play. But otherwise, it's a very tough market.
Yeah, I think there's how it's developed over those 10 years, and I guess the acquisitive nature of what's happened in that sort of space, and consolidation at various sort of stages. It's been it's been one of those areas that you probably looked at it and predicted it a little while ago. For me, I would have thought there would have been far more competition that would have gone on for far longer within it. But it seemed like they were built to last, as opposed to move around and compete for each other's business off each other over a sustainable period.
I think the way to view an OMS, if you try to take it to internalize it into your own life, you might find it entirely reasonable that you go and buy a new shirt to wear to work, and you probably wouldn't think twice about it. You spilt some ink on a shirt and you just throw it in the bin and buy a new one. It's not a big expenditure. You probably would think twice about buying a new house because you'd spilt some ink on the floor. You'd probably just wipe the floor up. I think OMSs tend to be more like moving house.
Yeah.
It's a big old project. It costs a lot of money. It's stressful, and it can tear people apart. I've seen instances where people have started off OMS projects, lose the confidence of the people who are paying the bills, and find their career has been ended at that firm by the failure of that project, and somebody's had to go in and rescue the project. Yeah. So I think that the OMS space is one that's bitten a lot of people. So there isn't a great drive to go for an outsider. I think the only real way that there's going to be change is a comeback play. So let's say market decided to throw some money at ThinkFolio and invest in integrating it with some of their existing systems and bring that to market.
That wouldn't be a tremendous surprise either, would it? If that sort of thing moves forward.
No, I don't think it would be a tremendous surprise. It would be exciting to see that, because I think that by having an element of competition, it keeps everybody on their toes. And I think it also forces people to really review what they're doing and how their business works.
Yeah.
One of the things that was always very good about ThinkFolio as a business was they had a very strong moral framework. It was almost the sort of communist empire, because it's always said that everybody got paid the same, and there was a very strong team ethos. The business has changed shape, the ownership's changed, the management team has changed, but they've got a good core product. But there's other systems out there that are pretty good, but they've just been in stasis. Again, using an analogy, if you buy a house and a few tiles come off the roof, well, you need to get up on the roof and fix the tiles or hire a roofer. But there's a constant churn of things that are required. If you think about, an OMS where you're connecting to a bunch of brokers, you need to keep up to date with changes in people's fix specifications. Now, if you use Fix Orchestra, that cuts the cost of that radically. I refer the honourable gentlemen and ladies to my comments ago. The thing is that it's like radioactivity. There's a half-life, and if you don't keep going, the system decays, the connectivity fails. And so if a platform hasn't been keeping up to date, there's a very high cost to get it back to being of market standard. And every year there's more and more functionality that people want from their RMSs. And so it's the war's over. I think Aladdin won. Charles River could make a comeback. ThinkFolio could make a play. I'd be fascinated to see what happens with Latent Zero. The Ion business model it's different to other companies. It's kind of closer, I would say, to SS&C and FIS rather than the Fidessa ownership. But they could, if they wanted to make a play, they could take on board the fact that Ion has got a massive footprint in equities, in FX, and in fixed income on the sell side. And
just the pure might of their acquisition trail is extraordinary as well, right?
Well, AP is a very, very smart guy, and he's got a very smart team of people around him. He's got a very different way of running a business, which isn't the kind of product first, egocentric model that a lot of vendors have. He looked at, from my understanding, the Ion way is to look at the financials, look at the numbers. And if you look at Aladdin, asset and liability data network, well, if that is a business model that's successful, well, one could say that very easily the Ion group could interoperate elegantly and do that in a way that could eat a whole bunch of people's lunches. It's something where, by having the buy side footprint from the sell side perspective, there's a great deal of value. Just again, as a little side note, but way back in 2002, when I worked at Fidessa, I actually pitched to a member of the board, who I won't name to embarrass him, that should buy, that Fidessa should buy Latent Zero. I'd met Richard Jones and a bunch of the people there, and thought, this could be exactly like Fidessa on the sell side in terms of its architecture, service-oriented, server-side, good architecture. And it was available for, at that time, about £4 or £5 million. They did buy it, but it was quite a few
5 years later and tens of millions of pounds more, wasn't it?
Yeah.
Told you so.
No, well, These stories.
I can say it, John. I can say it. The OMS wars, and that's the market is deeply coded into my heart and the DNA and everything that sort of came through over the last 10, 15 years. I love it, and I could talk about it for hours. I can't believe how quickly this sort of half hour has gone with you. There's so much more we need to talk about. Fixed income trading venues, the whole world of blockchain, data. Are you going to come back and have another chat with us?
Love to.
We'll do take two. I'm going to look forward to it. I really enjoyed today. It's been wonderful speaking to you. So much value. Always, a really interesting take on what's going on in the market. So I'm so grateful to you for sharing that time and that wisdom, and thanks for sharing it with all the viewers today as well.
Well, thanks very much for inviting me on the show. And I'd just like to say, if anybody wants to hear more, obviously this is going to be published online, but my blog, blog.alignment-systems.com, you can read more of my thoughts on these sorts of topics.
And I must say, it is always entertaining reading. So please do that. And John, thanks for doing that. And let's get take two in the diary pretty soon as well, because it's going to be another good episode. Thank you all for watching, and we'll see you soon in another episode of Fintech Focus TV. Thanks ever so much.